it would take very tiny amounts of desire to diversify out of sovereign bonds and into gold to create a heck of a squeeze on gold on a forward-looking basis.
This time, when rates go up, interest outlays will go up, and it's going to make the U.S. government, if you think about it as a company, as a worse credit.
This has been an income-driven cycle, and that's confusing to folks.
Hi, my name is Steve Feldman, and I am the founder and CEO of Wealthion. You may have seen me on the Wealthion channel as a guest on Anthony's Speak Up show. This is my maiden voyage as a host for Wealthion, so be gentle. I have as my first guest Bob Elliot. You probably have seen Bob is internet and YouTube famous, and we're going to help with that fame. He is the founder, CIO, and CEO of Unlimited Funds. And he is a graduate of Bridgewater, and he's also a graduate of Harvard, which makes me want to know why he isn't wearing a Harvard sweatshirt. Nice to meet you, and nice to do this.
Nice to be here. I'm happy I can be here on the maiden voyage,
yes,
as you say. Hopefully we don't get lost.
You know, I look forward to the criticism in the comments.
Well, that's the best thing about coming on a Wealthion podcast is the charitable interpretations of one's...
Right, it's going to be so nice to hear all the little things wrong with me. So one question jumps off the page. I saw in your bio that you did go to Harvard, but you were not a business major. So, but then you end up in a hedge fund, which is a bit of a stretch for, it says here, a science major and a history major. How does that happen?
Yeah, well, I think there's sort of two things that intersected with each other. The first was, I think, my background in sciences, and I'm a botanist actually by academic training, really brought me to think about the world in sort of, a scientific lens, cause-effect relationships, and particularly in the botanical sciences, thinking about systematics. So how do all the different elements of plant development, for instance, intersect with each other to get the plant that you see, in the ground. Mm-hmm. So that, I think, was a way of thinking, and that way of thinking, it can apply to the pure sciences, but also can apply to the world around you. And, in many ways, macroeconomy is just the world around you. That intersected with, during my time at Harvard, I spent a lot of time on global public health issues and development issues, particularly around political advocacy. Mm-hmm. And that was, I sort of learned over time, there's the political realm of what drives, good global public health outcomes. But the reality is a lot of what drives health outcomes is the macroeconomic environment, wealth, access to public health facilities and things like that. And so I sort of increasingly realized that, macroeconomics drives a lot of the things that I was interested in. And so I went to Bridgewater mostly because I was like, they're going to pay me pretty well, and I'll go for like a 2-year paid master's program, and then we'll see what I do. And I fell in love with markets and macro, and I'm still doing it today.
So most of our audience is here to understand about investing. It's primarily self-directed investors, but I have to say, there's always a fascination with the hedge fund, right? Mm-hmm. It's for 99.9% of the people and everyone outside of New York City. It's a black box. And so what does a day in the life of a hedge funder look like?
It's probably a lot more boring than what you see on Billions, I'll tell you that. I mean, a lot of what I did was create systematic investment strategies. And so in many ways, my life was similar to that people might think of as a quant in terms of what I was doing. And basically what I was doing every day was looking at the markets, looking at the macroeconomy, looking at how we were positioned in those markets, and seeing what were the sort of insights that were driving that macroeconomy on a day-to-day basis, and whether there was a way to basically take those insights and translate them into quantitative assessments of markets and economies that could be used to trade on. And so the interesting thing about that process is that that you get wrong a lot. You're wrong a lot. In fact, like a great batting average for an incremental systematic investment strategy that actually, if you go back and test across countries and across time, the odds that you have come up with a decent idea is probably 10 or 15%. In in terms of all the different ideas that you come up with, which is interesting because when people often have intuitions. They often say to themselves, I think this is what's driving markets. I think that's what's driving markets. If you actually stress test those ideas through time and see whether or not they're actually good ideas across markets, across time, most of the time they're bad ideas. Most of the time your intuition is wrong and bad. And that's very important because that's the beauty of systemization, which is you take that idea, you write it down, you quantify it, you test it, and you're able to separate between what are actually good ideas, replicatable ideas that you want to actually bet on over time, versus what are the ones that you thought were a good idea at the time, but may not be really consistent.
So the idea is that if you may not know which an idea is, which is the right one until you have hindsight. So do you have to hit 55 to get right to make money, or can you just size your bet, be right in 10% of your bets, make a massive allocation to that, and you end up just fine?
Yeah, I mean, I think different investors have different philosophies on this. Some believe that highly concentrated positions with outsized prospective returns can generate good returns over time. There's certainly some investors that have been very successful at that. It's not how I've thought about investing over time. I think particularly when you start to think about systematic approaches to macroeconomics, really what you're trying to get is incremental edge. So a lot of 55, 45 bets over and over and over again. If you take 55, 45 bets, say in any one month, and you take 50 of those bets and then you take them, month after month after month, you're likely to be pretty successful at what you're doing. But what that means is you're wrong 45% of the time. Right. So in your actual bets, you're wrong 45% of the time, and in your actual ideas, you're probably wrong 80 or 90% of the time. So I guess to go back to your original question, what's it like to be at a hedge fund? The answer is wrong all the time.
Right, got to get used to being wrong.
You got to be
like
wrong.
Baseball. You can make the Hall of Fame by being out 2/3 of the time.
Exactly.
So, people have watched Billions. You read the newspaper about the compensation of the Ray Dalios of the world, the Bridgewater, and all these other masters of the universe. When you show up in a hedge fund, are you working at Bridgewater? You're working for Ray Dalio? Are you working for the LP, or are you working for yourself?
Well, I think different funds have different approaches. A lot of, the things like the multi-manager funds have gotten a lot of attention where, individuals have their own book and they're sort of running money for themselves. That's not how Bridgewater was constructed. That was very focused on one portfolio, one team running one portfolio, and everyone sort of incrementally working on different aspects to try and build that aggregate portfolio to be better. But I think sort of at the core of running money as a fiduciary, as an institutional fiduciary, it really comes down, you are working on behalf of your clients. And sometimes that will force difficult choices, right? When you're making a decision between what is best for your client and what is best for you. It doesn't mean that, you're doing this as a charitable activity, but there will be tension points between those two. And I think when it comes down to it, holding in your mind that you're working on behalf of your clients, not on behalf of yourself, is frankly what makes people successful over time.
Are you concerned about your financial future or think your investments could be doing better? I'm Andrew Brill, one of the hosts here on Wealthion, and I've been there. Not sure my money was in the right places. It's why I've gotten help from a financial advisor. Maybe it's time you think more about your financial future or get a second opinion about your investments. We've made that process easy. Simply go to wealthion.com/free to speak with one of Wealthion's registered investment advisors for a free, no obligation portfolio review. Again, that's wealthion.com/free. I'm now less anxious and confident I can achieve the financial goals I've set for me and my family.
So, you're in a big name hedge fund, and I don't see your W-2, but I assume you're a well-compensated person. It's a well-compensated industry. You're not an old guy. You probably were not pushed out. So you decide to leave. Something had to go on in your head that said, okay, I show up. I got an important name on my card. I got a lot of zeros in my compensation, but I'm going to go be an entrepreneur. I'm going to start something different. Unlimited funds. I'll let you explain it. But let's go for a second. Just the idea of leaving. What goes through one's head. By the way, I left a big organization myself, but I was older than you are. And so I could sort of say I banked enough and the risk was diminished. What was in your head and why did you make the change?
Well, it's hard to believe when I started at Bridgewater, it was a challenger in the idea of systematic macro was unusual, let's say. It was more sort of the way of the savants, the Soroses of the world, big bets on markets versus systematic macro. Systematic macro now, if you walk down the street, here in New York, every hedge fund, every hedge fund has a systematic macro book or pod or whatever. And so it was great going to Bridgewater. It was still, even when I started there, it was a few $1 billion under management. It was a small team, really as challengers to the world of investment management. And I was lucky enough to be part of the small handful of investors that took it from being a challenger to an incumbent. But when you become the incumbent, the desire to innovate slows down. The desire to sort of continue to push slows down. I'm like, look, I'm in my 30s. I got a lot of life left in me. I want to keep innovating. And frankly, I'd always enjoyed being in much more smaller entrepreneurial challenger environments. And so that was an important reason why I decided to leave.
So now you have an opportunity. Tell us about Unlimited Funds, because you just didn't leave. You left for something, right? There had to be a pull, not just a push.
Yeah, and so when I was at Bridgewater, and also after I left, I spent a little time in the venture side of 2 and 20, and sort of increasingly realized that 2 and 20 managers and strategies, they're good for the managers, they're not great for the investor. And the reason why that is that hedge funds, venture capitalists, they generate pretty good returns, and they also charge very high fees.
Yeah.
And they take it for themselves. And that means that the everyday investor isn't necessarily that much better off than they would be on their own.
Yeah.
And so that got me to thinking, starting, I guess about 6 years ago, about whether there was a way to bring concepts of diversified low-cost indexing, but bring it to the world of 2 and 20. Obviously, it's totally changed stock and bond investing.
Yeah.
But when it comes to hedge fund investments, it's basically today looks the same as it did 40 years ago. It's, 2 and 20 managers, highly paid portfolio managers, et cetera. And my co-founder Bruce and I started to think about whether we could take our 5 decades of experience in the hedge fund business paired with modern technology, modern machine learning approaches, and basically build technology that allows us to see and understand how hedge fund managers are positioned in close to real time. And then take that, package it, translate it into long and short positions and liquid securities, and package it into products that are available to everyone, because we're doing it with technology rather than paying star portfolio managers. We do it at a lot lower cost. And so I in a lot of ways, I'd say I'm a reformed 2 and 20 asset manager. I was on the 2 and 20 asset management side for a long time, and today I'm back in the challenger seat, basically taking on big 2 and 20 managers.
And okay, so let's project out for a second. It's always interesting to me that even for an S&P 500 fund, there are different fees. Mm-hmm. And if everybody were rational, they would in all likelihood buy Vanguard. It has the lowest fee, or find some Schwab fund that had the lowest fee. So in essence, at a high level, what you're saying is I can give you a hedge fund performance, and I can give it to you at 90 or 95 basis points, and you don't have to have 2 and 20. And by the way, it's probably even more tax efficient.
The tax efficiency for taxable investors is a big deal.
Right, because when, as a hedge fund, and I've been an active hedge fund private equity investor, I find that what ends up happening is there's a lot of drag for taxes, and there's also a lot of drag for capital calls. So you get your money back, or you need to have it in waiting there for the capital call, so you're making cash returns, and you weren't making, up until a year and a half ago, that was zero. Mm-hmm. And so you were weighing your 17% return in private equity to the zero that you have making your capital calls. Then you got gains tax, K1s, whatnot. Here you can invest it, wait, decide what you want to do, and you can hold it forever and never pay tax. So long-winded way of saying that it would be very efficient for people, if they can get the same return, to pay 95% tax efficient than 2 and 20 tax inefficient.
Right.
But you have a modest fraction of the funds under management of Bridgewater. What's going to change that?
Well, I think for a lot of folks, they see the world of ETFs, which, an ETF is basically a tax loophole. And they see that as low-cost index products, which is right. A lot of the assets under management in the ETF space are still low-cost index products. But there's been basically 2 important shifts that have happened over the course of the last couple of years. One, there was a regulatory change in 2019 and 2020, which no one paid attention to because we were dealing with COVID, that allows active managers to run much more sophisticated strategies in that ETF wrapper.
Yes.
And that's very interesting because in a lot of ways, the ETF structure is actually most efficient for multi-asset, moderate turnover portfolios by washing away those capital gains. So instead of running it in an SMA or running it in a fund structure, if you run an ETF, basically every time you're shifting the positions in the structure, you don't have to pay incremental short-term capital gains on those positions. And so that's been a big change. And that paired with the fact that there is now a set of white label providers basically building an infrastructure to execute that in a much more efficient way. Basically at Wisdom Tree, which is a $100 billion ETF issuer, Wisdom Tree level costs for funds that are much smaller, those two things are combining together to create a unique opportunity to run these strategies in that ETF wrapper. I think we're early days in terms of investors recognizing the promise, honestly, of active ETF products. Really, it's basically like Cathie Wood's the only one, and she hasn't done all that great.
You need a gain to shelter.
That's right. And so I think slowly but surely, when we go out and talk to advisors, when we talk to institutional investors, they're increasingly saying, oh, now I see and understand this product, this structure is really effective at running these sophisticated asset strategies, and we're starting to get more and more flows. Many more flows are going on a percent growth basis, orders of magnitude higher flows into active ETFs than in passive ETFs.
Listen, I'm going to stop for a second. I'm going to make a public service announcement, and I'm going to expound on something that Bob said and something that I do in my own personal account. The ETF is a tax loophole. So if even back in the old mutual fund days, you were actually getting a statement that gave you your gains and losses from the mutual fund. And if you bought in a mutual fund on the day before the end of the year, you got the gains and losses from the mutual fund. The ETF can trade within the fund, and you don't get the underlying gains or losses that are in the positions in the ETF. You only get the gain or loss from when the time you buy the ETF or you sell the ETF. So, moreover, if you are in a private equity fund or a venture fund or a hedge fund, you have a K1 and you have to manage that. The ETF, you don't get a K1, it's in a 1099. And so the 1099 only comes when you sell. And so you could sit there and you can compound tax-free in an ETF where you can't in a mutual fund and you certainly can't in a private equity. And I'm going to say this with probably controversial, but a good short to make out of this. As a graduate of the merchant bank and doing a lot of private equity investing as the asset manager, there is a real, quote, tax, pun intended, on the system for somebody who's getting the gains managed by the manager versus by your tax lawyer or your tax accountant. So anyway, another reason why these unlimited funds are on a after-tax basis are better than hedge funds is because if you're getting the hedge fund return, you're getting tax efficiency, and you can decide when you're going to pay your tax as opposed to letting the asset manager decide when you're paying your tax. Anyway, back to you. So tell us, let's go back to these funds themselves, because there might be some people out here who want to learn more, and we'll send them to your website, of course. So tell us a little bit more about the strategy and the performance. Are you allowed to talk about the performance?
Some.
Let's talk about the strategy. And if some investor would like to learn more, they can talk to you and your team. So tell us about the strategy.
Yeah, I mean, the strategy, really what we're trying to do is use our technology to look over the shoulder of the most sophisticated asset managers in the world and understand how they're positioned and how they're navigating through various market cycles. And I think when you can do that and you pay full fees, it's not clear that's full fees and full taxes, let's say. It's not clear that's necessarily much better than being a passive investor.
Yep.
But if you can reduce the fees and reduce the taxes, hedge fund managers, they generate plenty of high quality returns. If you look back over the last 25 years, the industry as a whole has generated returns that are, equivalent to stocks with about half the monthly volatility and about a third of the drawdowns.
And how much leverage?
With a moderate amount of leverage, not a particularly extreme amount of leverage, and so that's really the promise of these hedge fund strategies. And I think one of the things that's interesting is when you get to this world of what I call alpha mining, which is essentially mining their views by looking at what they're doing. It also affords you the opportunity to create much more interesting products. So for instance, instead of taking hedge fund returns as they are, which sometimes can feel a little paltry, I think some advisors look at that and they say, I'm not sure about, they're consistent, but they're not particularly high performing. You can start to do other things like, how about take those returns and then run them at twice the expected return, right? Because you can put a little leverage into the ETF wrapper. And that generates a much more sort of cash efficient way to get exposure to those returns, plus puts it on par with, say, equity type volatility, but a diversifying return. And so those are the sorts of things that by using technology and mining the positions that these managers have on at any point in time, you can start to create products that you otherwise would never be able to get access to.
So you feature artificial intelligence. It's become, you can barely read 3 lines in the business press without seeing it. So what does artificial intelligence allow you to do that sort of regular human intelligence would not otherwise have allowed you to do? What are you getting for that? The fact that you are a pioneer in using that in the ETF, sort of hedge fund mimicking model.
Yeah, we're using various machine learning approaches. And the reality is if you've been in the systematic investment world for a while, like machine learning has always existed. And then the techniques are just getting better and better. And in particular, when you come to the what is a history of sort of replication of hedge fund strategies or manager strategies, there was always this challenge that existed, which is if you use sort of more traditional regression type approaches, you have to have a long back end, a long window, right? Because let's say a global macro manager has exposure to 30 assets. Most of their exposure is to about 30 different risky assets. Well, then you have to have at least 30 months of return information in order to run your regression, and likely longer. And then what you're getting a very long back history of saying, okay, well, I can tell you what the average exposure was of hedge funds over the last 5 or 10 years, but who cares? Like hedge funds move their positions through time. That's not that helpful. The alpha comes from the shifting of the positions. One of the neat things about using machine learning approaches and sophisticated modern Bayesian models is you can actually bring that understanding up much more to be much more timely than you were able to do with traditional regression techniques. And the reason why that is that you can look at today's returns and you can infer how what are the different ways in which the portfolios of these managers would have been positioned to generate those returns. But the interesting thing is because those returns are continuous, those positions are continuous, meaning today's positions are a function of yesterday's positions, you can actually start to have a better understanding of today's positions by looking at what adjacent portfolio generated the returns that we saw yesterday in the context of the portfolio that was necessary to generate the returns today. And so what we can functionally do in a way that we couldn't have done, it was not commercially viable, say 3 or 4 years ago, was basically build probabilistically what portfolio do all hedge fund managers have on, basically at all points in time back for the last 25 years and all the way up to today, to get our best understanding of today's portfolio, because that's what you want to have, right?
Are you basically taking all that information and putting in today's variables? Okay, so today's interest rates, today's PE on the S&P 500 to start to reshape what the model portfolio would be? Or is it just a matter of saying, under 1,000 different combinations of 50 different hedge funds, this is the one that would have worked the best?
Yeah, what we do is we look at the returns, actually. We infer the positions from the returns. And because we can see the returns in pretty close to real time, we can infer the portfolio that's generating those returns in pretty close to real time. And the reality is we've been, over the course of the last 2 years, been able to see how hedge funds are positioned faster than they report it to their clients, faster than it's seen in the media. And so we see moments in the markets where hedge funds positioning and shifts are actually driving the market action, where we can describe and understand that and communicate that in a way that it would normally take months or quarters before that becomes explored.
I would like to see, one time you'll come back on the show and you'll say, when XYZ hedge fund reports its 13F, here's what's going to be on it. If you could do that, that'll be a lot of credibility. Listen, I want to turn back to the audience for a second because, like I said, we're a community of self-directed investors. And so there's a when I read the comments or I see what people send to us privately, there's an enormous concern about being long equities today, where you have, and I think that's where most people still are positioned. I think our audience is a bit more skeptical, so probably has a little bit or more allocation outside of, say, just the core stock market. They have precious metals, they own farmland, they own real estate, they own other things. But just on the stock component for the moment, you'd look in history and you'd see a PE multiple above average. You'd see just the multiple of revenue of companies that would require enormous growth just to justify it on normal PE multiples, when you go from multiple of revenue to multiple of earnings. And so does your product protect people better? So we're all riding high, and I said, let's assume on a tax neutral basis, I could take a portion of my portfolio that's in equities and I can move it to your ETF. And then 3 weeks from now, there's an event and the market is down, and we won't want to, and it goes back to just normal valuations, which would be down about 30%. Is your fund going to do better?
Well, I think the question is basically, who do you want navigating through these experiences, through these dynamics? One of the nice things about what we've been able to do is to build an understanding of how hedge fund managers are positioned in these environments. And what they've shown over time is an ability to generate alpha relative to index investing, and to be able to pick the times when it makes sense to continue to be in, and pick the times when it makes sense to get out of those markets.
So in these funds, there could be a massive cash position.
There, absolutely.
I saw this morning, I don't know, this morning or this week, about the Buffett position. So he's sort of running almost similarly, he's running a tax-efficient business which has stocks and bonds and operating companies, and now $250 billion of cash, give or take. And so that's what you're getting. You're basically getting someone who's saying, I'm going to position the fund in a way. You're going to infer in the ETF that these hedge fund managers are positioned to protect against a scary market.
Yeah, if it's time to protect against a scary market, then they're generally pretty good at protecting against a scary market. If it's time to go in further, then they're typically positioned there. And I think probably from a risk perspective, I think one of the things, I think a lot of people hear hedge funds and they think hot shots that are making wild bets and trying to generate huge returns. And that's not at all how hedge funds actually generate high quality returns over time. What they generally do is they generate okay returns during upswings in markets, and they are very good at protecting the downside when that time comes. And the reason why they can do that is because they aren't long only, right? They can invest in a wide variety of strategies, manage their risk up and down, depending on the circumstances. And so actually the key for that long-term return, for instance, matching the S&P 500, is many years in which the return is, fine, but not notably, it's not notably better than the S&P 500. But when things get difficult, limiting that downside, and since the compounded return of an investment matters a lot in terms of limiting the downside, that's really where they shine.
Yes, I follow Seth Klarman and his principles of investing, and one of them is really a core component of my own personal investing, which is don't take losses. The massive drawdown, you're down 25 and now you need 33 to go back to break even, is really rugged. And again, managing my own finances, I'm a big believer in the stop losses. I'm a big believer in watching the market and continuing to test my own assumptions. By the way, I have Celsius, and I own the stock, and I got it wrong, and I got Farfetch wrong, and I got a few things wrong, but I didn't have the stomach to take it all down and rebuy. And I know hedge funds do that a lot better. Plus, they could actually truly hedge, put the hedge in hedge funds. Right. I'm not using sophisticated puts and things like that. All right, so let's take this. It's a good segue into markets. So I give you some credit. I don't know exactly whether it's 18 months or 2 years ago. The Fed starts announcing that we're going to do the pivot, and every mainstream economist and even non-mainstream economist says, okay, that's the end. It's over. Rates are going to go up. Whether you're pricing assets or you're pricing mortgages, everything is going down and we're going to be in a recession. You said no. And in hindsight, you're right, depending on what duration is, but let's give it that what I would say that the interest rate raising recession risk is now over because they're lowering rates. Tell us a little bit about that prediction and why. And then, if you wouldn't mind, tell us where we are today.
Yeah.
Because now rates are going down, but yet there seems to be more anxiety about recession in the market, which is strangely topsy-turvy.
Yeah, I mean, I think the key insight about this this cycle, which makes it quite a bit different from previous economic cycles that we've lived through in our professional careers, is that this has been an income-driven cycle, and that's confusing to folks because most of us understand credit-driven cycles. So where you have, a lowering of interest rates, which leads to an increase in borrowing by households and businesses, which then supports economic activity and is self-reinforcing until the point where a tightening by the central bank, tightening by the Fed, leads to a slowing of that credit economy, and we see a downturn. In this cycle, we basically saw no private sector borrowing. Private sector borrowing for the last couple of years has been at recession-like lows. What has driven this cycle, really over the last 2 years in particular, is income growth. Now, income growth, you sort of say, well, what's driving income growth?
Yeah.
And the answer is spending growth. And you say, okay, but what's driving spending growth? And the answer is income growth, because one person's spending is another person's income. And if someone has income, then they can spend it. And it's not that creates a spiral, it just creates a self-financing dynamic in terms of the day-to-day. And so if you look at income growth in the economy, household income growth, it's growing at 6 or 7% a year nominally, which is leading to spending growth about 6 or 7% a year. The thing about that dynamic is it's super sustainable because it doesn't build up credit excesses, right? If my income's growing at 6 or 7% a year and I'm spending at a growth rate of 6 or 7% a year, I can keep doing that essentially forever, right? Because I'm not taking on a bunch of debt. And that's basically what's been driving this expansion. And the important thing about that is if you're not borrowing, then interest rates can rise and it doesn't make much of a difference. Just take the median US household. They own their house, they've locked in a 3% mortgage, they own their cars outright, they're, have two people who are employed and their income growth is growing at, 5 or 6% a year. And not to mention the fact they have a 401k and they're getting all the benefit from stocks. That's a pretty good situation to be in.
Yeah.
Right? And that's a very sustainable situation to be in.
But I'm going to challenge it for a second, which is, agree it's sustainable, but how do you reconcile the fact that some of that income, I don't know, I'm not an economist, so I can't say the percentage, but some of that income is coming from an excess spend, or Lynn Alden would call fiscal dominance. I didn't know that word until she said it. So it wasn't so much about the tinkering of interest rates, because you're right, nobody was borrowing. Certainly the more affluent people who spend more were not borrowing because they own their homes and they own their cars and they don't take out, credit card debt too much. So, but you have this excess spend in the trillions of dollars that's coming in, and that has to land somewhere also as income. How does that play into it? And if that were ever to go into reverse, does that change your feeling? So strangely, interest rates didn't matter, but if Elon Musk goes in there and says, I'm going to take $2 trillion out of fiscal spending, I'd assume that would be disastrous for income. How do you reconcile that?
Well, I think in terms of the story of what's been driving the U.S. economy, you've got to go back to the COVID period. And in the COVID period, we essentially had a resetting of the amount of spending by the federal government and the deficits that the federal government was going to take on. And that happened in 2020, and it was an important offset to what was otherwise very negative private sector conditions. The issue is that adjustment, that increase in federal spending, largely happened back in 2020 and has been flat since. And so while the U.S. government is running fairly large deficits, the amount of spending, the amount of outlays by the federal government has been flat for 4 years. And if the federal government spending is flat, something else has to be driving that nominal GDP up. And that's where the income growth dynamic is driving up. So the fiscal support to the U.S. economy was very important in getting us out of COVID, but it hasn't. But what it did is it essentially ignited an income-driven expansion. Yeah. It didn't drive the income-driven. It didn't drive the expansion in the subsequent period. Now, going to your question about what if there was a big fiscal contraction, yes, of course. If there's a big fiscal contraction, that would be pulling growth, essentially pulling GDP away from the economy, and that would be very detrimental. But as long as we're staying at this level of spending, it's not the primary driver. What the primary driver is that income-driven cycle.
I am appreciative of and respectful of that call that you made, and around the same time, when rates were going up, Wealthion is in sister's business is GBI, and precious metals is that part of that business. And I made a speech to a group of FAs, and I said, this time when interest rates go up, gold is going to go up. Mm-hmm. And honestly, I was almost laughed out of the room. I had a lot of, you always, if you talk about gold among any, sort of what I'll call conventional investors, you get a little bit of a stink eye. Are you depressed? Are you scared? Are you a doomer? And I'm none. I just view it as an asset class and performs in a certain way. And I said, but this time, when rates go up, interest outlays will go up, and it's going to make the U.S. government, if you think about it as a company, as a worse credit. Mm-hmm. And so as a worse credit, people are going to say, well, it's a safe haven. Treasuries are a safe haven asset, but it's in a worse credit, and am I really getting enough interest to correspond with the increase? And you're going to see the answer is going to be no, especially for non-U.S. investors who haven't had the Kool-Aid that nothing ever goes wrong in the United States, and gold is going to go up. And it did, and that was very gratifying. And I know you're a macro guy, so gold's now at an all-time high. And what's your take on where metals go today and where the long-term treasury goes today? And you can tie it into Fed and fiscal however you see fit.
Well, I think when you think about gold, gold is a global asset, and it in many ways is just simply a good indication of that trade-off between fiat currency and hard money, right? And you're right that we've had a transition here over the course of the last couple of years where combination of high inflation, large fiscal deficits, has raised, and I should say geopolitical tensions, has raised the question about whether dollar and dollar bonds are, and really sovereign bonds in the developed world are really going to be the long-term storehold of wealth and benchmark storehold of wealth that they always have been. And really starting in places like China and Russia, and now increasingly seeing signs in the West of people seeing how gold is a good contra-currency to those bond holdings. The thing I'd emphasize there is that process is likely just getting started. If you go talk to financial advisors, see surveys of financial advisors, every investor in the book has stocks and they have bonds. Every single investor. And then you say, how many of your investors have gold? And the answer is like 1%, and those guys are crazy. Yeah. And so even though the price of gold is at all-time highs here, the ownership of gold, the effective economic exposure to gold is actually quite low. Because the vast majority of investors don't have any exposure. And so it wouldn't take much. The gold market is tiny. That's the other thing to recognize. The gold market, the monetary gold market in terms of what's traded is hundreds of billions of dollars on an annual basis. The size of the global developed world sovereign debt markets are, tens of trillions. It would take very tiny amounts of desire to diversify out of sovereign bonds and into gold to create a heck of a squeeze on gold on a forward-looking basis. And so while it's easy to say, hey, look, the price is at all-time highs. You have to contextualize that in terms of who has what exposure, and is the exposure high or not? And the answer is, by and large, the exposure to gold is not very high.
It's interesting that you talk about stocks, bond, gold. I was very gratified. I don't know if it was 2 weeks ago or 3 weeks ago. I saw an interview that made the rounds from Paul Tudor Jones and said, I don't own a bond. Neither do I. As a New York City resident and a taxable account, you're giving, let's assume there's an efficient frontier of risk and return. I was giving away half of the return to the governments, And that's fine. I like good infrastructure. But as an investor, it seemed, again, go back to your ETF comment. I think one of the things that I think the average Wealthion audience member and community member, and it goes beyond, is that people don't really understand the tax particularly well. And it bear repeating, which is if you own a stock that has no dividend and you're not paying any tax, you sell it and it's compounding, you're basically compounding tax-free. And so if equities make 7% and you're never paying any tax and you get 7% compounded. If you own a bond and it's a treasury and you're making 4%, you're giving 2 away, you're getting 2% compounding, and over a period of time, that's death. And so gold falls into the compounding category. People don't understand that it's by holding it, you're not giving away anything to the government while you're waiting. And I'm with you. It's unnervingly underowned by the masses in America, and it has beyond the performance issue. It's amazing that the performance of gold on a relative basis in any period of time, year to date, 12 months, 5 years, 10 years, this century, is excellent. But if you asked people what the return was and you didn't know, how does it compare, they would all say crummy. And they would say, but I'm not depressed and I don't think the world is going to end. Although there's some reasons to believe that there's more risk than people think. And it's always how strange, and it's got almost like a PR and branding issue. We should almost call it something different. And if I had an asset that performed this way, would you be interested in it? It happens to be cold gold. No, I'm not interested anymore. Wait, you're not interested in an asset class that's outperformed everything? Oh yeah, I am. It's gold. No. So part of what I do in my other job is try to convince wealth managers. That's why I do those speeches. But I am with you. I can tell you firsthand it's underowned. But I can also tell you there's something has happened. There's in the last 12 months, something has changed in people's brains about the world. Maybe it's reading the news and seeing 2 wars and seeing inflation and seeing presidential politics and seeing the valuation of the stock market and understanding how risky treasuries are. And is every central bank in the world wrong? And I think that has changed the calculation. I never predict price, but I have a feeling that it is going to grind its way forward.
I think one other thing on gold, we sort of talked about the strategic underowning of it relative to sort of the strategic dynamics. And then I think there's a tactical impulse here, which, like, if you just look over the last 6 or 8 weeks, has been an important indication of what we're likely to see with the market action in gold, which is a transition from the Fed for a long time was holding interest rates at an elevated level in order to stave off inflationary pressures. And basically what happened in mid-September was Chairman Powell came up and said, I'm going to cut interest rates, and I'm going to cut interest rates not because I'm trying to protect the economy. I'm going to cut interest rates because I think inflation's dead, even though the economy is strong. And that's and to a greater or lesser extent, that's basically what we're seeing across all other developed world central banks. That's what the BOE is doing. That's what the ECB is doing, cutting in response to an economy that's not that weak, not sort of the level of weakness that is akin to, say, the financial crisis or something like that, cutting as fast as they did, or planning to cut as fast as they did then, in an economy that's not anywhere near as bad as the financial crisis. And that sort of over easy policy, that's the sort of thing that starts to raise the question of whether you really want to be holding bonds in an environment of over easy monetary policy. And while the market action in the last couple of weeks has been pretty counterintuitive, the Fed cuts aggressively and the bond yield rises 70 basis points. And that's a classic indication that monetary policy is too easy. And if anything, what we've seen is Chairman Powell has doubled down on too easy monetary policy. In those sorts of environment, I'm sure, basically everyone holds bonds. If you're not holding gold in that sort of environment, you are not protected from what is likely to be overly easy monetary policy.
I like to just bolt on to that, which is the box that the Fed finds itself in. If it's going to interpret data, it's going to have to interpret it in a way that reduces rates because they're the largest interest player on the planet. And so the notion that if there's a 50-50 ball, to use an NFL term, if there's a 50-50 ball, they have to cut rates because with a a trending $1 trillion a year interest expense, don't they want that to come down? And there's so much rolling every month, and the defense budget is $800 billion, and now interest is more than the defense budget. That doesn't paint the picture of a healthy country and a healthy credit. If you are paying more of your taxpayer dollars, and listen, I'm not a doomer, but it does feel doom loop-ish to say that you have $1.8 trillion deficit, $1 trillion of that is interest. Oh, and by the way, it's now north of what your defense budget is, the reason why America and hegemony is so good, and why the country always feels safe and there's no wars on our border. And so it's complex, and again, I get accused of talking my book because I do have a precious metals business. But at the same token, it doesn't feel right. Like, there are times in the markets when it felt like we had stasis and it was calm, and the people who were trying to sell you gold were trying to scare you. Mm-hmm. I'm just saying is the world's not working right. Interest rates are cut and bond yields go up. You have a $1.8 trillion deficit, and people are shrugging their shoulders that you're paying $1 trillion in interest, but $800 billion on defense. That should give people some pause and to move and rethink their allocation at a minimum, and as opposed to just saying it'll all work out. Mm-hmm. And by the way, that's another thing that's a whole tenet of Wealthion, which is be informed, make informed decisions. All right, so let's go. So if you're sitting here today, and we just talked a little about gold, a little bit about bonds, if someone's not in your fund yet, and we'll talk about how we'll close this telling them how they can get more information. So how would you position somebody who's high net worth, mass affluent, they've got money they're not trying to, pay their credit card bill this month. How should people generally position, or at least be tilted today versus where they might have been 4 years ago?
Yeah, well, I mean, it kind of dovetails to the conversation we just had, which is that the first thing I'd say is if you're holding sort of a traditional 60-40 portfolio, and in particular you don't have any gold in your portfolio, there's the one most efficient improvement in your portfolio diversification is moving up to 10% allocation to gold.
What's second?
The second, I'd say, is recognizing that in an environment of overly easy monetary policy, there's really two things to keep in mind. One is it favors stocks and gold relative to bonds. The second is it will likely favor those those companies that have been underperformers. And so it's easy to chase the high-flying, yes, very elevated expectations of those, of the Mag 7, the equivalent. And I think the challenge is at some point you see the expectations are so elevated that it's very hard to meet them. The types of things that are priced into essentially the AI trade today are incredibly implausible. For instance, the expectation would be that margins would double from here. That's very, very hard to see how that's going to happen over the course of a few years without, the flip side of a margin expansion is actually paying people less. So it's not magic, right? If you're going to pay people less, then that's got to be made up somehow. Yep. And that's likely not going to happen. And so I think moving away from those high flying stocks and finding other areas of the market that are less loved. So for instance, commodity stocks that are trading at 10x.
Yes.
Right? Those are boring. Those are boring companies. They don't make for good cocktail party conversation, but if you're starting to think about how do I invest in a way that's going to compound wealth over a 5 or 10 year time frame, you're going to do better buying stocks that are, trading at 10x, on healthy margins and decent earnings growth than those that are trading at, 40x with unbelievable expectations.
I would say, just as a general rule, investing is as much about creating a system and living with it and not changing around and chasing the next trend. I'm sure because of S&P 500 funds, I have exposure to the Mag 7 and
that's plenty.
Info, right? Plenty of info. But when I press the button, I make an individual share purchase. I could never bring myself to buy something that's 70 times earnings with these projections or a multiple of revenue. Never. I wouldn't call it contrarian, but it's just some discipline around earnings multiples, some discipline about what the projection looks like in order to justify today's value, or said differently, among bringing it back to hedge fund people, some margin of safety. And if you do that, rinse and repeat, and you do it over very, very long periods of time, and you're very mindful of taxes, you can compound over long periods of time. And wake up one morning, I'll tell you, I laugh because when Fidelity does its reporting of who's the best and who's got the best investment performance, the people who have the best investment performance are dead. And the second are the people who forgot they have the account. And so definitionally, trading is risky and difficult to do. It should be left to professionals. It should be left alone, and you should have a system. And I think a system that sort of stands away from the crowd is probably a better one, but I'm not a hedge fund person. Okay, so this has been great. You wouldn't come on the show unless you wanted people to know a little bit more about Unlimited, except for maybe you want to hang out with me.
Of course,
fine.
yeah.
So how do people learn more about Unlimited Funds?
Yeah, you can learn more about Unlimited Funds at unlimitedfunds.com.
I'm sure you own that URL.
Just that simple. And look for our products on the various discount brokerage platforms that are probably in your pocket on your phone. And if you want to follow along in terms of my ongoing thoughts about macro markets, the economy, I'm at Bobby Unlimited on Twitter. Okay. The same on YouTube. I've just started a TikTok channel. No dancing.
You're very fashionable.
But a morning overview of what are the key things driving markets, so check me out on your favorite platform.
So one of the things that Wealthion really tries to do is provide. We say we're a financial education channel. Over time, we'll offer products. Right now, we have advisors for people who don't quite want to get a more professional insight, which I think is a part of our audience, but not everybody. Are you providing education, webinars, things that are like people can really move themselves up to better understand markets, but also to better understand your product? Is it something, do you have white papers? Do you have something? What would you tell the person who really says, listen, I'm a thoughtful investor, never done this before. I saw this TV show, Billion, so I know what a hedge fund is, but I'm living, I live modestly. Hedge funds always gave me, a headache. What would you tell that audience member today, the person in the Wealthion community? How would they really get smart and make a super informed decision?
Yeah, we've got a ton of information giving perspective on the drivers of hedge fund returns, why indexation of hedge fund strategies make a lot of sense, and how our technology is actually doing this in a quick, easy to access video form. All on the website. So if people want to sort of roll up their sleeves and dig in and better understand what we're doing, that's really the place to go.
Last very hard question.
Yeah.
Wealthion community member, $1.5 million net worth outside their home, 55 years old, still working, but wants to retire in their 60s. What percentage should they have in a hedge fund type vehicle like yours?
Yeah, well, I think if you look at the most sophisticated asset managers in the world, they allocate about 20% of their portfolios to what I call alpha strategies. So
institutional investors.
Institutional investors. And I think the challenge for most everyday investors is how do you do that in a way that isn't a huge headache? And our idea is to bring one of many products that are available to basically fill that slice, that 20% slice. There's a lot of good individual, in many ways what we are is the SPY of hedge fund or alpha generation. And you might have particular managers that you like their investment strategy, you like their tilts. Absolutely go out there and invest in those strategies, and think about what we're doing as sort of the low cost benchmark in that slice of your bucket.
Listen, as always, be informed. Listen, I've gotten to know Bob. Can't say we're best friends, but we are on the same page as investors. Highly informed, very interested in markets, careful with our own money. Take some pride in that. So I would encourage people to go to the website, and whether you're an investor or not, there's a lot of interesting information on it. So anyway, thank you very much for coming on. We'll have you again, and thanks for indulging my maiden voyage.
Thank you so much for having me.
Great, thanks.
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to wealthion.com and sign up for a free, no obligation portfolio review with one of our registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. And if you could like and subscribe to the channel, we'd greatly appreciate it. Don't forget to hit the notification bell so you can find out when we post new videos to the channel. Thanks again for watching, and until next time, stay informed, be empowered, and may your investments flourish. And if you like this content, please watch this video next.